Welcome. I am MASB Director of Communication, Eric Deckerhoppen, and I'm welcoming you to the Making Marketing Accountable webinar series. Episode 10, Why Brands Must Be Valued in Financial Terms. Today, we're getting into the second edition of the Financial Value of Brands Imperative. This was from the original white paper in 2022. It has been completely updated and includes updated measurement provider summaries from Brand Finance, Kantar, Interbrand, Ogilvy, and Prescient, as well as additional content, including the Bud Light brand divorce, which was also written by our presenters today. And it's available on Amazon and Barnes & Noble. So today we are going to hear from Jim Meier, a longtime MASB member and a director from 2013 to 2018, and ever since a trustee and treasurer. He has extensive experience in marketing finance with Philip Morris, Miller Brewing Company, and Miller Coors. And he is joined by Frank Findley, his co-author, MASB executive director since 2017. Frank has been instrumental in the creation of global brand evaluation standards, working through ISO Technical Committee 289. And with that, I will turn things over to Jim.
Okay, thanks, Eric. So appreciate everybody joining us today. And we'll start off here with a few thoughts that you're going to hear amplified throughout our half hour or so that we're going to cover the material. So answering the question why brands must be valued in financial terms. So one of our key tenets, not only of the book, but of MASB, is that marketing exists to drive profitable and sustainable growth through increased demand. There's a quote in the book from one of our MASB summits a few years back that the manufacturing side of the business can purchase and maintain an asset. Marketers can create and grow one. It places marketers in a fairly unique position within an enterprise, and it's no coincidence that path from the enterprise to the consumer, is called the value chain. It is where a significant amount of value and cash flow is generated by the enterprise. Long-term growth, and the focus here again a bit on long-term, comes from the enhancement in brand preference and expansion of the customer franchise. And so as I was prepping for this, I was thinking about an enterprise we all know, Costco. Costco in and of itself is probably a brand unto itself. They also have a brand within a brand called Kirkland. And when you think about that company having a $400 billion market cap, not only would you say they've certainly had long-term growth, and it's both branded and expansion of the customer franchise, which I think all of us know or may be very, very loyal subscription customers to Costco. And given that growth is measured in financial terms, and think about that $400 billion number, the strength of brands and the resulting customer franchise, we believe, must also be expressed and analyzed in financial terms. And we'll talk a bit further over the next several minutes about how that can be done and why it should be done. And what's interesting is, despite the obvious connection between marketing activities and the meeting of long-term monetary goals, the financial value of our brands is not frequently measured within many enterprises. And one way we see that is this chart represents 45 years of information in multi-year increments. And it's showing the percentage of the Standard & Poor's 500 market value or market capitalization divided into tangible and intangible assets. what we see going back nearly 50 years now is that once upon a time, market capitalization was heavily driven by tangible assets such as cash, inventory, accounts receivable, property, plant, and equipment. And we can see over time how that has changed significantly. It has more than flipped over. And you'll see many variations of this information, but directionally, something in that 90-10 place where we are about now is what you're going to see. And I mean, the fact of the matter is right now, tangible assets are really only a mechanism to produce or to enhance the value of intangible assets in many cases. Now, when many people see this slide, they immediately might come to the conclusion that much of this is driven by relatively asset-light, high-margin tech companies. And there's some truth to that. But if we go to the next slide, we'll see that many companies who have been around for decades, even over a century, are showing this dynamic within their numbers. So these are 4 companies. You see those down the left side, which you're likely familiar with. Perhaps Constellation Brands not, but so quickly they're the U.S. importer of beer brands such as Corona and Modelo. They have a few other businesses as well, including cannabis. But as you see these 4 companies, and this is information as recent as we can get it as of their latest annual reporting date. Let's just walk through Procter & Gamble. Now, this information for them, their latest fiscal year ended June 30th. And so this goes back to June 30th, 2024. If you look at their balance sheet, they have current assets of $25 billion. This is all in billions. Current liabilities of $26 billion. So in that current assets number, that's cash, receivables, inventory, among other things. And a working capital of essentially zero. And you see this down with the other 3 companies as well. Property, plant, and equipment of $22 billion, and then a market capitalization of $389 billion as of January 31st. So you have to start asking yourself, why are people paying that much for Procter & Gamble stock when the physical stuff and other tangible assets are so small? Well, short stories, it's driven by strong and sustainable cash flow generated by their brands. But here's a bit of the dilemma. There's a gap in GAAP, GAAP being generally accepted accounting principles. As it relates to brand value, sometimes these values are disclosed and sometimes they're not. So in some specific examples, the first 2 related to Procter & Gamble. Tide and Tide detergent and Crest toothpaste brands date back decades. And there is no brand value shown in Procter & Gamble's balance sheet for those because they were generated internally. On the other hand, Gillette, which was purchased back in 2005, I believe, there is a value for Gillette on their balance sheet because they paid something for it. If we switch over to Disney, the Frozen franchise is not on their balance sheet. However, Marvel is, because again, that was also purchased back in 2009. The but on Marvel is it's on their balance sheet, I think around $3 billion. But if you think of how many Marvel films perhaps you on this webinar have gone to see, or your children or whatever, it's rare that the value of those brands goes on at $3 billion and then it stays there. And it isn't updated due to what we call the moribund effect. And so really GAAP based reporting does not do a very good job in providing to investors, to banks, to stock analysts, what the true value of brands are on the balance sheet. Here we see that same chart, but we've just added the far right column. And so you can see that disparity between market cap and the tangible assets of the respective companies. But then you see the brand and trademarks, as currently reported on the balance sheet, are nowhere near taking account of the true brand values. A potential exception here is Kraft Heinz, who came to be as they are now through a series of purchase transactions, which accounting standards or GAAP require them to place values on those brands. In all these other cases, there's no requirement that the entities do so. It's not that they're playing any accounting trickery. They're all following accounting principles, but you can see the disparity in result. One of our fundamental beliefs at MASB is, as we look at where is this headed, is that changing accounting standards to put all brands on the balance sheet may, in fact, not even be feasible. And I think it's I personally believe it's very unlikely to occur anytime in the near future, even though it may be the ideal outcome. So our viewpoint is that brand-centric enterprises should develop an internal methodology to annually measure, explain, and report the financial value of brands to the executive level, even in the absence of any external regulatory or accounting requirements. Apart from putting brands on the balance sheet, you could imagine in public filings such as a 10K, perhaps the management discussion and analysis section could include some discussion of brand value. My guess is if that were to occur, it'd probably likely start on a voluntary basis. And there probably aren't a whole lot of companies who are willing to take the leap and volunteer themselves to do that in the absence of an external requirement. But to us, actually, the more important thing is that an internal methodology to be developed for management decision-making purposes. This is not just to check the box to do it because it's fun. We want to do it because it improves decision-making over time. And especially in a portfolio of brands type of enterprise, which I used to work for at Miller Coors, now Molson Coors. We had a lot of brands, and understanding relative brand values at a point in time can do many things. One thing is potentially inform marketing spending priorities. I'll show you a couple of visual examples of how this could be applied. Another analytical tool that could be used by a company that implements an internal methodology is that you can look at a change in brand values over time. So in this particular case, going into year one, we have a brand value, and coming out of year one, going into year two, we've computed a significant increase in that brand value. And we explain the various reasons for that. Well, apparently the category grew, we grew market share within that category. We actually got stronger from a pricing standpoint. It cost a bit for us to do that in terms of cost of goods and in marketing spending. But what CEO or shareholder wouldn't love seeing this chart across a portfolio? And this could be used by a CMO to go to the senior leadership team and shareholders and suggest, at least on this brand, that more marketing spending, properly conceived, is a very good idea to further enhance that $105 million value on the far right. just three brand examples here in terms of how they're positioned and how you might measure them and what the investment implication could be. So brand A in a flat product category, but a growing segment with very strong brand preference. Frank will talk a bit further about brand preference in a little bit here. Our pricing is in line with the competition. We have strong distribution, and what all that suggests is probably a growing and sustainable cash flow over into future years. And so if we were going to use a discounted cash flow or DCF model to establish brand values, we might say in this case, a 10-year detailed projection plus a terminal value might be what establishes that value. And we might suggest that an implication for investment is that it ought to be relatively high and likely increasing over time. I won't go through both of the other brands, but quickly with B, what you can see is while we're in a growing place in terms of segment and category, we believe the brand preference is relatively weak. And this is potentially a difficult scenario to deal with. As the cash flow implication here is that it's likely unsustainable. And we still might want to dabble in this a little bit, have some minimal investment, but with the ability to curtail. And in this case, we might not want to assign any brand value at this point, as sort of a wait and see what happens. I'll just ask Eric, do we have any questions at this point before we pass things off to Frank?
We do. Jonathan Knowles would like to know, do you think that marketers are better off going it alone in terms of arguing for marketing intangibles versus making common cause with HR and R&D to promote a more comprehensive approach to intangibles?
I think probably, I certainly wouldn't rule either out. In either case, you're probably going to need your CFO's support as well. From my perspective, I would probably lean to going it alone, not disregarding the other option. I think as you look at, for instance, let's take HR. A company could argue that it has superior talent or superior approaches within HR, either talent or methodologies of, retention and growth to establish a value. How that would be done is probably even more difficult than how you would value brands. I'm not disregarding the fact that those intangibles exist, but I kind of want to go solo with this, and I think it could be a step toward putting values in the future on intangible R&D capabilities or HR capabilities.
Thank you, Jim. And hello, everyone. It's a pleasure to be with you here today. It's kind of interesting because MASB has been on this journey for quite some time. This movement towards the financial value of the brand and this recognition within management really got a major push in 2020 when the ANA and MASB jointly released a survey results on this topic. And one of the amazing things that came out of it was the answer to this question. Going forward, how interested are you in having a process in place at your company to measure brand value? And at that time, 61% had replied back high interest and very high interest, and 86% were a top 3 box with moderate plus interest. And this was a huge finding because back in 2020, there were very few firms that actually had started down this journey outside of the areas of merger and acquisition or the selling of a brand to another enterprise. So this was very encouraging in 2020 to see this interest, but it showed that the case was already being made that people recognize the of brand valuation. They understood the value of brand valuation to their enterprises, but they were struggling to get going on it. And that's really what started this journey for the financial value of the brand and the idea behind what was started off as an article but has turned into our book about it. And one of the key things when we delved back in was, well, why was there with this level of interest, why was there so slow of an adoption rate versus other techniques? And part of that has to do with the way in which brand valuation cuts across functional areas within the organization. As Jim was just saying, the importance of having the CMO and the CFO and the CEO involved, that you had various if you will, internal areas had to be involved, and people had to be jointly work together or have people with dotted lines assigned to lead efforts. As Jim can talk about it a great deal because he played that role for quite a bit at Miller Course. But there were some other obstacles that were more conceptual in nature as to why these brand valuation approaches weren't being adopted within the mechanism so quickly. And these quotes kind of from the paper summarize this a bit more. One is that brand values can't be measured. There was simply a skepticism that there was no meaningful methodology to actually do brand valuations. Another one are that the amounts are soft. That is, they are more subjective in nature than objective in nature. And so this came from highly from interesting enough from the accounting practices area. But as we pointed out in the book, as we worked more and more with FASB and other entities on accounting standards perspectives, it really was determined that it wasn't much different than any accounting approach. Even the GAAP rules, as Jim pointed out, have some built into them some subjectiveness as to when a brand is put on the balance sheet or not. And even things like inventory, you have decisions which have to be made versus, for example, first in, first out, or last in, first out type of items for accounting purposes. So that one I think, mostly has vanished on this whole soft, especially as people have become more aware of and have seen the great work that has been presented by the brand valuation firms. Another one that came up is published brand value measures from sources such as Brand Finance and Brand Z are divergent. A lot of the early time was spent on looking at these divergencies, and it is true that there were differences by the different brand valuation firms, not just Brand Finance or Brand Z, but all of them, Interbrand and so on. Brand Finance and Brand Z are the ones that are most quoted because of the publication of their league tables. Are kind of a media event, and so they are compared more often to each other. But in these kind of situations that they are divergent, but there's an understanding that each of them has developed an approach for a specific type of application. And so part of those divergencies can come from the type of approach that is taken to the brand valuation. But there's also a lot of similarities between them when you look at those tables as to which are the most highly valued brands. And while the rankings may vary a bit, you don't see where one is a top 10 brand and then it's a top in the 40 or 50s on the others. There is some alignment between them, which points to a general underlining truth there. And another question has been, we already have sufficient metrics and don't need another. And this has been one where, which you might call metric fatigue, that people have adopted so many measures that they're almost paralyzed accordingly. And so I'd like to talk about this a little bit more, because when it comes to the financial value of brands, that's not a really fair characterization, because it oftentimes doesn't lead to new metrics. It leads to a greater understanding of how metrics are linked together and then the financial implications of that. So I wanted to talk a little bit about our brand investment and valuation model. This is a conceptualized model of how branding translates into financial value of brands that was conducted with the help of 6 companies who each had provided large amounts of data on their own brands as well as competitors, and for over a 2-year tracking period. So in that particular study, we had all the different type of variables that you see here, along with the brand associations, common marketing ones like awareness and loyalty and net promoter scores, and quite a variety of different type of data from the marketing side. And we were able to link that together through this 2-year process. It was one of the largest initiatives that our industry had taken on to date, and it's still one of the most cited. You can find versions of it on WARC and other entities. But getting into the results, this particular model kind of laid a framework that allowed marketers and finance people to talk together about how they come together. And so I'm going to walk through the model rather quickly here, and there's a lot more details associated with it, and there's full mathematics that underline the model that can be found in the MASB MASB papers, white papers, which are available at the masb.org. But just to walk through. So basically what happens is that brands do activities, they do marketing, they do other type of, functional type of aspects for the brand where brand investments are made. Those brand investments lead to associations for the brand. So they strive to create these mental associations with the brand. As well as physical associations as well. We'll talk about distribution in a moment. And then there's also external activities, a major one, of course, being competitive activities. Competitors are doing the same thing. And then there are environmental factors that have to do with, interest rates. And right now, we're dealing with a lot of trade-oriented restrictions or constrictions is probably a better way of putting it, that actually go to availability of brands. But in any case, those activities, whether they be the brand's activities or external activities, they end up leading to a preference with the consumer, where they prefer one brand over another, or at least within a consideration set, that certain brands are within their consideration set, others are not. That doesn't mean that they will always purchase that brand. It's a proclivity towards them acquiring that brand, because there are other factors, and those factors include things, for example, the relative price, so a price premium versus the category, and distribution, how available or findable that those products are in the marketplace. So those play a pivotal role as well. Interesting enough, the brand preference actually is kind of a loop with those, because brand preference plays a role in them. The stronger the brand preference, the more price that you can charge, the better ability to maintain a price premium without losing share. So that's a key factor for brand preference. And also brand preference, the more preferred a brand is, the more likely that retailers will want to have it on shelf, because in some cases it's demanded that it's on shelf, otherwise they'll lose traffic, whether that's online or whether that's brick and mortar. If you don't have the brands that people are shopping for, then they're less likely to shop in your location. So retailers go out of their way to ensure that they have brands with high brand preference on the shelf. The other aspect of these come together, and they lead directly to market share. And in the studies that we released, you can see the correlations. We go through these analysis of 120 brands in the categories categories for those 6 companies that we talked about in detail on how these 3 factors come together and project market share at a very high rate. But in any case, collectively that goes to which brands and branded products that are actually being purchased by the consumer. That in terms leads to velocity, and category volume also plays a major role. If you have a growing category, then you have a tailwind that's helping advance your velocity forward. And of course, if your category is contracting, then you're facing headwinds from the category. But in any case, that leads to the velocity of the money going through the firm. The price premium also impacts margin, which then collectively those two lead to an operating cash flow now and projected into the future. And that cash flow, along with other real options or optionality that comes from the brand, for example, the ability to move into new categories and to do line extensions and things of that nature, is what leads to this financial value of brands. So the underlying motto is that the brand ensures future cash flows, and one way to have confidence that on that is to take it back to the marketing metrics, these associations and brand preference, which is the result of these associations. By looking at that will give you confidence in the future cash flows and also make it less soft in viewpoint of the finance people, because there's something underlying your projections going into the future. So that is the underlying MASB brand investment and valuation model. Each brand valuator has their own system for their own framework that they use as which metrics they recommend, but they generally follow this similar type of an approach to connecting the marketing variables with the financial variables. And that's one of the key aspects that comes out from a management operational standpoint, is the ability to marketers to talk in financial terms and for finance people to understand the contribution of marketing through this process. So this framework helps that collaboration internally accordingly.
Frank,
Yes.
Eric Wackenstaller says that the statement "brands drive growth" is a bit of a generic statement and does not really have the level of granularity necessary to be trusted by the business. Do you feel this model addresses that?
I do indeed feel this motto addresses that, as well as other research. If you look into the white paper, you can see strongly the relationship between the brands, the contribution of the brands to market share, and ultimately to the financials and the cash flow. So it's not a puff claim, if you will. It's empirically found with underlining mathematics on how, by measuring these marketing metrics, you can have confidence in the financials that you will generate going forward.
Well, Joanna Seddon says that marketers are fearful of numbers and of approaching their finance people. She also says brand valuations associated with numbers and league tables, which vary not as a way of understanding both the asset value and how the value is created and what they can do to grow it. Do you agree?
Yeah, I do agree that some marketers are fearful of having these conversations. But when we talk about on the marketing teams internally, we also have to understand that the insights teams can play a role. How that's organized is, within the firm, can vary. In fact, we have a MASB project on the marketing organization project that is delving into that on how marketing is organized internally. But those insights people can play a very critical role, especially when talking to the finance people, because they are not afraid to talk in terms of math, right? They have been working with these marketing metrics just like finance people work with finance metrics, and they are able to come to basic underlying levels about the quality and the proof, and it's an empirical question. You will do a validation exercise when setting up these systems, and so people can have confidence in that valuation side. League tables are kind of an interesting thing, because the league tables themselves, there is only limited information. They're being created from publicly available information, and so when you talk to the brand evaluators, and and you have that conversation about their league tables, they all will come forward and say, of course, if we have, when we're working with a client, we have more access, we have access to more information, more accurate information from the internals, which are not publicly available, and therefore we can tighten those numbers. So the league table question, often comes down to, there has to be a recognition that those league table values are based upon publicly available information as applied. So they're based on the best information available, but working directly with a brand valuator, you can get, much more precise and accurate information.
Joanna, I also ask, how do you add brand risk to the analysis? Should we consider the security of the future cash flow associated with brand, and should it impact the discount rate used in the valuation?
Yeah, so that's a fantastic question. That's where the brand preference comes in, and you saw it earlier in Jim's table when he was actually talking about the implication for the brands and how it translates out. We strongly believe that the use of brand preference association, what we'll call brand strength, is a more general term. The use of brand strength to give credence to future cash flow is highly important. And there are a lot of exercises which can be done. For example, one of the most useful ones is actually dividing up the brand preference by generation so that you can see how you're doing on generation. We have seen multiple cases where currently the brand has a very strong position, but if you look among the younger customer base, the younger consumers, you see an erosion. In those particular cases, then that's something that needs to be recognized, that will impact future cash flows and your future cash flow assumptions, and those cash flow assumptions need to be adjusted. As far as the risk aspect for it, in these discounted cash flow models, the risk which is associated with it is primarily a market-based risk, and so it's generally been treated as a taken for what the cost of capital is for that firm, for making investment purposes. So while you could put an additional risk in that, we haven't seen a lot of that. We've seen much more of the actual adjustment of the cash flows going in. But I see Joanna has raised her hand. She may want to have a more interactive discussion on this.
So I don't agree, actually.
Okay.
And I know that this is a disputed accounting thing, so Jim might want to weigh in on this, because you can have examples where the brand is strong and the business is weak. So the strength of the brand is very different. The strength of the cash flows associated with brand and the discount run, the risk associated with them is lower for the brand than it is for the business. You can have a great brand, which whose value is pretty secure, on a rotten business. I can give you an example. If you take the old AT&T brand, before it split up, it had, at that time, it was a on the long distance telephony business, fixed line telephony business. If anybody remembers that, most of the people on this call are probably not born then. But at that point, that was a dying business, fixed line, long distance telephony, but it was a great brand. And the proof of the pudding was you could take this great brand with a very, unrisky value off the rotten business and put it on a new business, and it added security and risk and enabled them at the time to become the dominant player, which was mobile.
Yeah.
So that would be my an illustration of why the risk of cash flows associated to the brand is not the same as the risk of cash flows associated with the parts of the business that is not impacted by brand.
Yeah,
Anyway, that's my point of view.
Yeah, I can actually see that, Joanne. I would say in general, what Frank said regarding cost of capital is the approach that is used most frequently. There are exceptions, and that's actually why we have practitioners who do this for a living.
Yeah, and that's why we have in the model the real options. So the example that you just gave of AT&T, that's a very, pertinent example of real options. The ability to extend the brand into new areas. I mean, just look at the extensions that have occurred into new categories for the Apple brand, over time. Or one of them that we have documented quite heavily, Jim and I both have written on it, is the Hostess brand. There, when you talk about a business that's not doing well but a very strong brand, that's a tremendous example of that, where you had the brand was actually valued at more than the business itself. Because of the contracts and other things that brought down the cash flow of it, but those things, I think the risk to the cash flows, though, from what we've seen, is that people will adjust the cash flow numbers going into the future, not the discount rate. So that's where I was pointing out in the motto, is that to what Jim just said, is that typically that's how it's handled, where that risk to cash flow is actually put into the cash flows. Maybe they'll do multiple scenarios, for example, under cash flow things, but the discount rate is generally what we've seen is for the firm itself, for their general, for all investments. Jim, you can correct me if
No,
otherwise.
I think that's generally the case. Not to say that there couldn't be an iteration that would look at it slightly differently.
Yeah, absolutely. Yeah. Yeah, the important thing is that it's actually taking into account, and those conversations are happening within the enterprise between marketing and finance teams, and the brand teams.
When it gets into the issue, Frank, of when people talk about the numbers being soft or disparate between measurement providers, I think one of the key points we get across in our book is that pick a methodology based, pick a reasonable methodology and apply it consistently. And it's not to say that you won't tweak it a little bit over time, but don't radically move from one approach to another. That's what I would say on that.
Yeah, and that is why one of the main key parts of the book itself was provider profiles, where we worked with the brand valuators to actually create a profile that goes over the overview of the service, the method, the key inputs, the key outputs, their typical timing, cost, geographic coverage, and the contact information, to have those conversations and to find one that fits with your company, and how you can go forward. So we have that available, so that you can find a methodology, working with them externally, or you could develop one internally. But there's a lot of value to working with the experts, in this case, who have seen a lot of things. And so you can choose one and then move forward with them over time. And that's where you'll see those changes are what's important, as Jim was showing on the bridge chart, where you can monitor it over time. Annually is a good time period now, from how people have been implementing them.
Frank, Nick Ericom was wondering, since companies often update their financials on a quarterly basis, what are your thoughts on how often a company should do brand valuations?
Yeah, that's a great one. The recommendation that we made in the book, based upon all the conversations, not only with the companies, but with those providing the service, came down to a annual, except under the situation where where the application isn't just managerial for setting strategies and investments, which typically happen annually. But if there is any consideration for merger, acquisition, or divestment, or major serious changes in the environment, then you may want to put on a more common cadence, or a faster cadence for having them done. But generally, the strategic benefit seems to you get a lot of strategic benefits from doing it annually. Jim, I'll
That kind
since you're
of,
here.
yeah, the other thing, Frank, it marries up with a lot of annual processes within a company, such as resource allocation.
Yeah, and the whole thing about resource allocation includes the marketing budget, which is a huge one, right?
Yeah. That's the big resource, yes.
Yes. So that's the advantage. On the other thing on doing soft, one of the exciting things which has come about in the most recent years are new studies being released on the relationship of brand valuation to stock market performance. And I think this goes to the heart of why brand values are you know are capturing more and more interest from the CFO. In particular. So this is an example which is in the book from Kantar, provided the data from that shows their strong brand portfolio. So in other words, they took the brands from their Brand Z studies, and they looked at the brands which were the highest valuation ones, from that, and created if you will, a portfolio of them, and then track that versus the S&P 500 and the MSCI World Index, and you can see the result. Their portfolio is the one in green, of course, accordingly, showing that companies who do have strong brands tend to outpace the general market. Brand Finance simultaneously did analysis in a similar type of fashion. In fact, they have their logic is embedded in a fund which is currently being on the trade front, which you can look in. But the Brand Finance logic is being used to create a portfolio of brands for investment purposes currently. But this is an example where they also chose to compare versus the S&P 500 as a benchmark and their most highly branded companies portfolio that they generated on the other side. And the interesting thing about these is that you can see between the books that these were forward-looking. So these were not just backward-looking analyses. These were analyses that over time are being updated, and we see the more and more the divergence over time. So if you look at the past books, you'll see different time scales being presented accordingly. And so, Jim, this gets to what you were just mentioning is about gaining that buy-in, the executive buy-in. So what's the path forward? It really is to get the executives to agree to actually look at this. Because in many cases, a lot of the information is already there. It's just a matter of creating those linkages and putting in place a system, identifying a methodology for doing that. Focus on reasonable and consistent goals for accuracy in analyzing trends. As don't make a lot of changes as the methodology goes forward. As Jim was saying, make it consistent, and so you can see the build over time, how the values for the brands change over time, and then incorporate those FVB calculation and marketing return assessment processes, including resource allocations as well. So whether it's a ROMI or ROI or a CI, continuous improvement in return, based on how the company looks at their investments, incorporate that FVB within it. So that is our main recommendation, and our conclusion is that by adopting a philosophy for FVB provides transparency and credibility to the marketing function across the C-suite. It shows the contribution that marketing and brands make to the enterprise while informing the strategy and tactics to grow enterprise value. So that's our key conclusion, and we are happy to open up for further questions.
We have one from Hexen Ogan. How can the real options portion of the model be used to measure the financial value of a brand, especially in cases where the underlying business performance declines significantly, but brand equity remains strong? And he brings up Kraft Heinz as an example. Both brands had strong consumer recognition, but the stock price dropped. How can we isolate and measure the enduring value of the brands themselves despite poor business outcomes?
Jim, would you like me to take a?
Yeah, take a shot, and then I'll supplement it with my thoughts, because there's probably a few different viewpoints on that one that could be debated.
Yes, and Kraft Heinz is one of the probably the most looked upon entity right now as far as brand valuations is concerned for gleaming practices from it. Part of that has to do is because they have a portfolio of brands, which is very helpful, but it's portfolio of brands under a constant management. And part of it is because of they've had these changes, these management changes over time, and the valuations were, because of that, placed on the books. And so we can see the some of the write downs in brand valuation as they occur from their current numbers. One of the emerging stories which has occurred is one that I mentioned earlier about generational losses, where when the values were put on the books from that process of changing over of management, that those values were a high estimate because there was actually the strength of the brand among younger consumers was actually weaker than it was looking at it overall. And so there is that discussion. In fact, it's very active. You can see from the last 3 or 4 months, there's been more discussion on that particular aspect for Kraft Heinz. The real options refers to going into new categories or new areas for a company, so extending the brand in new directions. And so the way you do that is you actually do projections based upon new product research accordingly for what cash flows could be. Those are the least firm of the you'll have your least firm confidence. You'll have the lowest confidence in those because you haven't, if you're doing it at the concept stage, you haven't released it to market, so you're making more assumptions than you would for established brands. But it definitely it can set expectations, and then you can see how the results compare to those expectations. So Jim, I'll pass it back on your side. Those are my thoughts.
Yeah, I think on the valuation of the optionality thing, it is, Frank, the hardest thing to possibly quantify, because sometimes you're not going to know it's the opportunities there till you do it and see it. So it's a very, very hard one to incorporate. As Kraft Heinz has studied, I just cheated and called it up on my iPhone here, but 10 years ago, Kraft Heinz traded around $90 a share, and it's under 30 now. So obviously there have been some problems there. Berkshire Hathaway, I believe, owns a significant amount of Kraft Heinz, and Warren Buffett himself has said, I overpaid for Heinz, I believe. So, but I think there are there are probably some fundamental brand preference issues within their portfolio. Not to say that they could not be rejuvenated in a certain way. And there may very well be options there that haven't been tried yet.
Yeah, and the other aspect of real options is that if it's truly in a new category, it's also driven by the speed at which the category is adopted by consumers overall. So we've seen that with, for example, with EVs. It's been moving since the 70s, right? But it wasn't until the 2000s to where it really gained traction for electric vehicles. And similar things we're seeing on the other side of that, we have AI, which has exceeded all expectations for adoption, and the brands in there. So you have both the the brand aspect, but you also have in those cases category aspects.
Yeah, it'd be interesting to know, Frank, if Disney, when they released Frozen, the initial full-length feature film, if they knew they were going to be doing ice shows someday.
Yeah, that's right.
Or they'd be on Broadway.
Yeah.
All right, that's all the time we have. So thank you to Frank and Jim. And please join us in July 16th for our next episode with Peter Young of Prescient for Beyond the Black Hole, Quantifying and Leveraging Brand Value in Financial Reporting. Hope to see all of you there.